Good morning, everybody, and welcome to this morning's Wealth Briefing webinar in association with Advent Software. Today we're looking at the link between technology provision and advisor productivity. Is it a help or is it a hindrance? We're joined today by a panel of experts to discuss this subject. They are Martin Engel, Market Strategist of Advent Software, Wendy Spires, Head of Research at Wealth Briefing, Ian Woodhouse, Director of PwC, and myself, Stephen Harris. I'm the publisher of the Wealth Briefing group of newswires. So before we start, I'd just like to ask our panelists to introduce themselves briefly and tell us a little bit about what they're doing in their work life. So can we start with Martin, please?
Yes, thank you, Stephen. So in my, I work as the market strategist for Advent in EMEA. And as such, we are servicing a large group of organizations within the wealth management space across the EMEA region. So hence we see a lot, and we are daily in touch with these firms in regards to helping them be strategic on their technology and how technology can actually help them improve their business and become more profitable. So we find that we are more or less on top of things, as we have clients in our client base that range from very small boutique wealth managers up to the very large tier 1 institutions. So these are some of the views that I have talking to our clients that I will share today in this webinar.
Thank you, Martin. Ian?
I'm with PwC on the wealth and asset management consulting side. I'm currently focused on working with clients around front office advisor productivity improvements to meet regulatory changing regulations and client needs, things like RDR and things like MiFID. What we're seeing more recently is the rise of digitally enabled advice models and advisor models, and what I'll do is share some of these experiences with you today around what we call the new client-centric advisor model.
Thank you, Ian. Wendy?
I'm Head of Research at Wealth Briefing and author of the report that we're discussing today. I've actually written many reports on all elements of technology in wealth management, but my particular area of interest is in the digital client experience and innovations around mobile and wearables and those kinds of things.
Excellent. So just by way of background then, Wealth Briefing and Advent have a long-standing research partnership which has seen us explore a great number of technology and operations trends in wealth management in recent years. So over that time, technology has become central to the wealth management dialogue as the industry has faced and continues to face pressures that we're seeing from regulation, margin pressures, and also the huge changes in clients' preferences. And it's been very fascinating and interesting to track the dramatic changes in attitudes towards innovation year on year, and to see business strategies change as the adoption of new technologies unfolds. Yet the report that we're looking at today, the new report, the link between technology provision and advisor productivity, really is one of the most interesting ones that we've ever looked at. And studies that we have produced to date show that advisor productivity is a huge topic for us to study. So Wendy, who is the author of the report, is going to take us through some of the findings of this new report, and so I'm going to hand over to Wendy now.
Thank you, Stephen. As you'll have seen, and Stephen has mentioned, the title of the report we're discussing is Help or Hindrance, the Link Between Technology Provision and Advisor Productivity. This title was chosen very deliberately to reflect the study's main hypothesis, and that's namely that there's a widening gap between the leaders and the laggards on the technology front in wealth and asset management, and that correspondingly many advisors are being held back from performing at their best. As we know, technology investment has been very uneven across the industry for a whole host of reasons. With this study, we aim to examine whether current technology setups really are a help or a hindrance to advisors, and to discover which areas are really presenting the biggest challenges in their daily working lives. One of the first areas we investigated was how technology-enabled advisors are in preparing for client meetings, which obviously makes up a big chunk of their working day. Here we found that 21% of advisors are spending upwards of 2 hours preparing for an annual review meeting, and 79% are spending over an hour. The situation seems to be slightly worse when it comes to preparing proposals and pitch materials to take to a prospective client. Here we found that 48% of advisors spend upwards of 2 hours on these preparations and 84% spend over an hour. Now, it's difficult, obviously, to say how long these things should take because a lot depends on the type of clients in question and the firm's business model. But most of the expert contributors to the report believe that a really technology-enabled advisor should only really have to spend an hour or so on meeting preparations, and obviously that's very far from the case for many advisors. And this suggests that there are massive time savings up for grabs at many institutions, and I think we should always remember that advisors' time is very expensive. We're looking further into the reasons why meeting preparations are so arduous. It became really clear that the old spectre of legacy systems is still looming large at many firms. The survey showed that advisors are having to use many disparate systems which don't really talk to each other very well, and as a result, a lot of them are having to put a lot of manual work into meeting preparations. So, for example, we found that 46% of advisors are having to access 3 or more systems to prepare for an annual client review.
And as Wendy's going through these slides, I think it might be a very good idea if the audience thinks about questions that they can ask both Wendy and the other participants as we're going through. So please feel free to ask questions, note them down, and we'll be going through those questions at the end of this presentation. Thank you.
Thanks. So to continue, we have advisors having to access many disparate systems in order to gather all of the information that they need to present to clients. We also found that 43% of advisors say they're having to put a lot of manual work into preparing for annual reviews. And as you can see, automation currently stands at such low levels that only a tenth of advisors say that they can do these kinds of preparations with very little manual work being required. And I think a lot of that is actually cutting and pasting really and that kind of work. Now, advisors naturally want to spend as much time as possible in proactive discussions with their clients and their prospects. But obviously we're seeing that in many cases they're having to spend a lot more time preparing this information rather than having actual face time to go through it with clients. The contributors to the report said that some advisors can spend only 40% of their working hours with clients and prospects now, and some have even said to me that that figure can be as low as 25% depending on the client loading at a firm. Now, client-facing time has always been of paramount importance in the wealth management industry, but I'd say that several factors mean that spending the maximum amount of time with clients is more essential than ever today. First of all, we're in a unique investment environment that calls for, I would argue, really in-depth discussions to set clients' return expectations correctly. Secondly, I think advisors are playing a far more educative role nowadays. Lots of research has shown that the clients really want someone who's a navigator through the choppy waters of investment at the moment, and someone who can really bring expertise to the table. And lastly, regulators are, of course, enforcing a lot more transparency on fees as well as investment performance. So there's a real need to have a deeper conversation with clients about the costs, but also the value of investing. So another of the key areas we investigated was whether technology is enabling advisors to offer sufficiently customised investment offerings to their clients. Here we found that advisors really are being let down by the systems they're having to work with in many cases. We found that a third of advisors don't feel able to offer clients the kind of investment flexibility and choice they need to actually achieve their objectives. But perhaps just as importantly, a similar proportion don't feel that they can offer the kind of interesting investment opportunities that help them to engage with clients and have something fresh to say and offer to them. As we know, and I think we'll touch on this later, cost and regulatory pressures are really driving a kind of creeping homogenisation of offerings in many segments of the wealth management industry, and therefore I think it's reasonable to assume that investment choice is going to become even more of a differentiator as we go on. And again, as we'll mention later, there's this real rising appetite for alternative investments at the moment, so that just goes to show that traditional assets aren't solely people's focus anymore. Significantly, when we looked into this issue, we found that alternatives and derivatives coverage was somewhat lacking for the advisors that we surveyed, but obviously there are a great deal of asset classes and investment instruments which might not be as well supported as they might wish. So we have ethical overlays, private equity and tax efficient investments, just to name a few examples there. The next area we looked into was performance reporting, and here we found some pretty worrying inadequacies actually. Here we had over half of advisors saying that they're unable to offer the optimal reporting solution to their clients, and a quarter rated their firm's reporting capabilities as poor or actually very poor on this front, and a further third said that they're only average. Likewise, we have half of advisors having serious doubts about the quality of the audit trails that are generated by their firm's investment platform, and they also feel that the technology systems could be more helpful in terms of helping investors understand why certain investments were chosen and how they performed against their expectations. But more worryingly still, we found that half of advisors have concerns over the audit trails their firm's generating from a regulatory perspective. So a quarter rate the audit trails generated by their firm as poor or even very poor in terms of satisfying regulatory obligations, and a further quarter gave only an average rating on this front. And I think the huge compliance dangers here are clear. We also investigated the level of technology innovation advisors have access to, and here it became apparent that many are missing out on core tools entirely, like mobile apps. I think this is an area where the gaps are really, really widening. I think it's important to note that wealth management is a highly competitive industry when it comes to both clients and advisors at this point, and they'll have abundant comparison points from their own careers, from the careers of colleagues. People are aware of the stuff that's out there and what's available to them. So I think that the kind of technological capabilities that are seen as a differentiator today, like mobile, for example, might actually become a hygiene factor for both clients and advisors before too long. As I hope you're picking up, this was a very wide-ranging study. We aim to look at many elements of the advisor productivity question. But if we were to reduce the findings of the report down to one key point, I would say arguably that it's simply this. Many advisors just don't feel that their firm's technology setup is fit for purpose in the year 2015. So we have 6 out of 10 advisors saying that they don't feel their institution's technology platform is particularly useful in terms of helping them to support their existing clients and to win new ones. And worryingly, a quarter actually think that their firm's systems are poor in this regard. So against this backdrop, I think it's fairly predictable that advisors are increasingly thinking about technology provision in the context of their careers and how facilitated they will be. But actually, I was quite surprised to see just how much of a priority this is. We found that 76% of advisors said that a poor investment platform would be a significant or very significant factor in prompting them to change employer. And correspondingly, a similar amount said that they would be, if they were thinking of changing firm, they'd carry out some kind of due diligence on the technology provision that they would be offered by their new employer. I think these are very striking findings, but they're perhaps as we might expect. As Martin in fact said in the report, the lives of some advisors are made actually really difficult on a day-to-day basis because of a poor technology setup. And as another of the experts in the report said, if you've had this experience as an advisor of having this really difficult day-to-day working life not being facilitated, you won't want to repeat it. At a time when modern technology can boost productivity so powerfully, to be actually hindered in your work must be frustrating in the extreme. So to conclude, suboptimal technology setups seem to be hindering many advisors today, and at the heart of that seems to be legacy systems, poor systems integration, and a slow adoption of innovation. Things are changing, however, and we are seeing big investments and indeed complete overhauls at all manner of firms all over the world. We have to acknowledge that making these changes is sometimes far from easy, and I think with technology the temptation is often to leave well enough alone. But I think what we're actually thinking about is institutions starting to see that good enough isn't actually good enough anymore, and that their clients and their advisors deserve the best possible technology provision. As we've seen, I think success will increasingly depend on having a leading technology setup, and that's on many fronts, and one of those is in recruiting and keeping the best advisors and then helping them perform at their best every day.
Thank you very much indeed, Wendy, for taking us through the key findings of this important research piece. And also thank you very much for the audience for asking questions. I can see quite a few coming in now, so please keep them coming. Before we go to those questions, there are a number of issues that I'd like to address with the panel right now. So the report found that many advisors think that their firm's platform is poor in terms of it helping them win new clients and supporting existing ones. We'll discuss the elements that might affect productivity in depth throughout the session, but first, just at the top level, what springs to mind when you hear this? Which technology complaints do you feel are most common, and does this change according to type of firm or region? And I'd like to address that first to Martin.
Yeah, thanks, Stephen. This is actually expected, unfortunately. I was not surprised when I saw the survey findings, but it is actually slightly shocking that less than 1/5 actually said that they are best in class. I think they are best in class on technology. I think there's very few other industries out there in the market where that same thing would actually be. So to me, this tells a story that the current state in regards to technology and how you interact with your clients is definitely not ideal for the industry, either for the firm, for the advisors, for the clients. I think this is also a reflection that, seen from a vendor perspective, we have seen that in recent years, post the financial crisis, we have seen underinvestment in IT, and especially in the front office. This is actually changing now, and I think perhaps Ian can allude to that. So we are seeing much more emphasis because people, they realize that they are underinvested, and this is actually a matter of that unless you actually invest in these things, it might be difficult for you to actually to be in business, or at least to be profitable, if you just look a few years ahead. So some of the things that just springs to mind when we hear that, and what people are more or less complaining about, it's small things actually. The basis is that the numbers that I'm actually looking at as an advisor and that I'm sending out to clients, that just needs to be correct. I need to be able to trust that the figures, the calculations, the performance measures, etc., those are correct measures. It might sound trivial, but that is actually a very common issue in the industry. And as an advisor, if you don't trust the numbers, then it's difficult to actually be looking great in front of your clients. And that's in general, when you really cut it down, you'd say that IT is actually there to make advisors shine in front of clients. It is actually to make advisors look great. So this is the way that an advisor is, get a higher success rate in order to attract new assets or retain assets. So I guess one of the things that is very much these days is on mobility and digital solutions. So the lack of that as an advisor is really hindering. That's what we hear, because some of the statistics, when you look at asking an end client, high net worth individuals, it is obvious that the younger generation below 40, they would all expect digital experience, but perhaps more surprisingly, when asked, then actually more than 80% of the above 40-year-old, they actually also do expect a digital client experience. So that is one of the key things that I would be mentioning at this stage.
Wendy.
Just to add to Martin's comments on the mobile, it's actually surprising the counterintuitive almost adoption of tablet technology in the over 65s. I think in both the UK and the US, research shows that 1/5 of all over 65s are daily tablet users. And in a financial services sense, I think it really appeals in a way that the smartphone perhaps doesn't, because of the complexity of the information. So yeah, it's something that clients are demanding, and certainly advisors again want to look good in front of their clients. If a client turns up to a meeting with a tablet and the advisor themselves doesn't have one, that's not great.
Okay, indeed. So the report revealed that many advisors feel restricted in terms of the investment choice they can offer, in terms of giving clients what they need to achieve their objectives, but also in terms of offering interesting investment opportunities. Client rising appetite for alternative investments has been well documented. Which asset classes and instruments do you think are rising in importance, and why, Ian?
Well, I think the first thing to say is that traditional asset management classes are under pressure from product innovation, and you've really got two ends of the spectrum. At one end, you've got the rise, or the rapid rise, of low-cost passive ETFs, and at the higher value-added end of the market, you've got the rise of alternatives. And actually, when you look at it, the growth rates in both of these are significantly more than the traditional asset management growth rates. Alternatives, for example, are growing twice as fast as traditional investments, so you can see pretty big change on the way. So what that means is advisors need new product solution skills and information at their fingertips, so that they can explain the value added of these new instruments to clients. So you have hedge funds, which will really help the advisor with the clients in dealing with volatility. You'll have things like property and infrastructure type investments to help the clients with inflation protection. And it's going to be much more around communicating complex ideas and solutions now more than ever, which is new skills for advisors. The other thing is that this is also beneficial for the firms, because the alternative space, although it's only about 13% of the total of assets under management, it contributes very good fees and margins, so it's also important from a commercial aspect. So it's a win-win from the client view and also from the firm's view in terms of the commercials. I do think, though, you need to keep the compliance aspects to the fore, and also advisor skills in this, because compliance becomes much more important as we go forward, as recent regulations are stressing client protection, suitability, and these sorts of areas are at the heart of what the regulators are driving for, both in the UK with the FCA, but also now with MiFID II in Europe. So in summary, big changes underway there in the requirements for advisor skills, and this also reinforces the need to have good technology behind them supporting them.
One of the expert contributors to the report identified an institution-to-client approach where firms stick to the investments that they can cover easily and ignore the rest. Do you see this as prevalent? This is a question for Wendy, actually. And how much of a factor is technology in the restriction of investment offerings? Wendy Spires.
I think we need to circle back just very briefly on what Ian just mentioned. There are perfectly legitimate reasons for investment offerings to maybe be somewhat narrowed. There's regulation and risk. There's firms wanting to stick to what they know, what they're good at, rather than trying to be all things to all people. And there's also a cost-effectiveness play there. But equally, I did hear a lot about the technical difficulties of kind of sewing alternative asset classes and the more esoteric investments into investment portfolios. Obviously, this needs to be done for portfolio management, also for analytics around asset allocation. When you bring alternative away assets into the mix as well, things can become very, very complex. But a lot of it is down to pricing, particularly around illiquid assets where they might not have visibility on a day-to-day basis, but also different firms vary in terms of their methodology for valuing certain assets, so that creates complexity. So it's legitimate that they maybe stick to what they know, what they can do easily and cost effectively, but as Ian mentioned, there is this need for greater variety and to stand out for investment offerings, I think.
Martin.
Yeah, no, I definitely think that technology is actually a factor here in the Hindrance. We see that when in our daily work with our clients, there tends to be new products. Complexity is rising, and also you need to find those instruments that can generate alpha in those kind of markets. And this is some of the things that where getting the right strategic technology partner is highly important. Just on a yearly basis, we spend around 50 million euros just developing our products, and a lot of these actually goes into supporting new, more exotic instruments, because you need to be able to deliver, what makes sense to your clients, and IT should definitely not be a hindering factor. So you need to consider that IT and technology should actually be there to support business and not the opposite way around. But it definitely does have impact, and I think it also leads to the fact that these things about being able to service different front office models, whether it's like mandate advice-led models or it's more advice-led versus mandate-led. There's different requirements and different priorities that you're actually having as an institution. That needs to be reflected by the IT platform that you're utilizing. And we have a lot of discussions with clients around that. And we see that it tends to be that the most successful ones are actually those that have a very clear business model, because those that have said that you cannot be everything to everybody, but you have identified kind of your niche segment, your core client base, and you also know exactly the offering that you're providing those. This might actually mean that you are, not offering all sorts of instruments, you're not offering all markets, but you have a very clear strategy and vision that you're actually focused on, and IT then needs to support that. And that's where we have where the client and vendor relationship is highly important, to have that discussion so that you have the right expectation set.
So the report found that almost half of advisors are spending upwards of 2 hours preparing a proposal and preparing to pitch for a new H&W client. So Ian, does this surprise you? And where is the main bulk of work going on? And what do you see the efficiencies to be had? Ian Woodhouse.
Well, it doesn't surprise me because advisors now have to spend a lot more time preparing their proposals and their pitches, and the reason it's got worse is there's a lot more compliance to go through with suitability and appropriateness, and also in getting product and performance and risk information together, and then making sure you present this in a clear way to the clients and it's all evidence. A lot of inefficiency exists in pulling data from the multiple systems that Wendy mentioned from the survey. There's a lot of rekeying, there's a lot of checking, a lot of internal coordination required, and this is all done in many players in a quasi-manual way, trying to coordinate between different departments like compliance and investment specialists, for example. And I think the prize here is how we use technologies like workflow and better data management, better investment management systems to automate this through better role and what I call rules management.
Thank you very much. Wendy, do you have any comment to make on that one?
Yeah, I think it's as Ian said, it's about efficiently using what you've got to a certain extent. In many cases, client information exists elsewhere in the institution, maybe from a corporate relationship or some other kind of relationship at the firm. So ensuring that doesn't go to waste, as it were, is a good thing. And I think also, as Ian alluded to, a lot of the time people are trying to use tools that weren't really designed for the task. So the use of PowerPoint, for example, so you're cutting and pasting between disparate systems that don't talk to each other and putting that into a further system which wasn't designed for the task at hand. So that's not great, again.
Martin.
Yeah, no, I just want to say I'm not surprised, but we actually, before we did the survey, we were actually talking about what were our expectations, and this is more or less the expectation I had. And I think a lot of it, just because I totally agree with what has been said, is also the fact that we see that there's a lot of manual work going on here, and it has to do with the fact that often, you don't have systems in place that cover multi-asset class, that cover all the jurisdictions you are basically, servicing clients in. So this means that you need to, use several systems, and this just adds on to the number of hours that you need to spend in order to preparing. And one of the things there is just that operational risk is just going through the roof for many of these organizations. So there's huge benefits to be had.
So how about annual client reviews, though? We've spoken about proposals and pitching to new clients. How about existing clients with their annual reviews? Ian?
Well, again, this doesn't or shouldn't surprise people, because I think a lot more effort now goes into ensuring things like accuracy of performance reporting, and as was mentioned previously, making sure the data is accurate. I think also, again, you see compliance also changing the rules of the game, because it's increasingly important for advisors in the annual client reviews to check the client circumstances, to check their client risk profile remains the same. And I think also there's much more emphasis on advisors articulating in very specific terms what the risk profile actually means in terms of the likely losses that they might achieve on the portfolio in today's more volatile economic environment. So I think there's a lot more work that goes into preparing for these client reviews, and also lastly but not leastly, they need to be evidenced so that they're on the client file, so that when the regulator comes to look at your compliance, the evidence is there that you've done a good job in terms of suitability and appropriateness for each individual client.
The reporting inadequacies were a real area of weakness. Martin, can you please comment on how extensive you think these are and how easy it is for advisors to cope with the need for workabouts and workarounds?
Mm-hmm. I think that overall, I think it's very common to have inadequacies in regards to your reporting. And that, honestly, in 2015, that shouldn't really be a challenge. Things should just be working. So, because in today's reality, I think that client reporting equals client communication. So if you don't have like a digital presence and a digital client experience, what an end client is getting from you is actually the reporting that they have access to. This is more or less your face out to the end client, and I guess this actually is a lot, that you need to show towards your clients that you have order in the house, that what you're producing is definitely correct, and that you also, via your client reporting, you are actually able to explain the investment process. So these workarounds, I think, is actually causing a lot of headache, because workarounds is often, it can be small things like, you don't have sufficient pricing on all your instruments, you might not have the right NAV on some of your funds, etc. So all these things just means cost, it means time away from client-facing time from advisors, and it means risk, because if you have manual workarounds, it just means that there's no process. And going back to what Ian was mentioning in regards to the regulators, you need to have full audit on everything that you're doing. So, and we sometimes see that manual workarounds, isn't really audited, so you don't have like a full trail. So that also causes problems down the line actually. So I definitely say this is highly common, and I think that a move forward towards investments in more digital solutions could actually help that.
Wendy, could you please comment on reporting inadequacies?
Yeah, just to build on Martin's comments, I think really the performance reporting is kind of the alpha communication in the client life cycle. It's where you show your proof points. Your job as a wealth manager is to preserve and grow capital, and where else are you going to evidence that KPI? But in the performance reporting, obviously the use of client portals is on the rise, but often I hear from clients that actually the email PDF is something that they're quite keen on because they like to print it out and have it in their hands. But equally, they want customizability around that, and I've spoken to clients who said that they wanted a very simplified chart of their asset allocation just so they could see where they're invested, and have asked repeatedly for that to be implemented over months and months, and it shouldn't really be a huge ask for them to be able to have that baked into their report, rather than them having this 60-page document which is set in stone and doesn't really show them what they want to see in a way that they want to see it.
Okay, can I just make one additional comment? Because ideally, you would say reporting should actually be your platform to justify the value of the advice that you're granting. So you need to be able to show by your reporting, like over time, recent and historical, what has your performance been? Because I agree that that's a key point. Where are you generating alpha? Can you explain your investment strategy in great detail? And then actually, finally, I guess that's one key thing is that, if you have a sufficient detailed and sophisticated reporting, it will actually help you cross-sell other products. And that, I think, is a missing link here as well.
So does consolidated reporting present a particular problem, Ian?
Well, I think consolidating reporting, or as it's probably known as aggregation across custodians and banks, it is in evidence in some markets like the US, and particularly for certain segments like family office who like to get an aggregated view of where their assets are. But it hasn't really yet taken off in Europe, and I think there's probably a few reasons for that. I think one is that clients are probably worried by security of divulging all their assets and securities. So there's issues of trust, I think, become more important to overcome. I think also it's difficult with the systems to interface. But, you have to recognize that as clients and advisors have found in the US, at some point the value created by aggregation and the ability to leverage some of the new technologies and digital to get an overview of all the assets, which can then be mapped against goals and performance, and also for some clients, I would add the assets and liabilities. This will probably show a value which outweighs the security and privacy concerns. And I think, secondly, the European regulations such as PSD, upcoming will help in driving the more openness towards aggregation. But I think we're going to see that over a period of time.
Thank you very much. So there's been quite a lot of discussion in the report on how advisors need to be collaborating more internally, such as bringing in an investment expert to explain performance. How easy is this kind of collaboration today, Wendy? And how can technology make things easier? How important is it to show that clients that this kind of behaviour behind the scenes is actually going on? Wendy Spires.
I think there's two strands to this. There's obviously the facilitation of the collaboration itself, so whether that's through messaging platforms or internal social media networks, that kind of stuff to facilitate the actual communication in what might be a global banking group with tens of thousands of employees and specialists in products and markets dotted all over the world. But I think it's also about evidencing, as we've touched on throughout this webinar, and showing clients the value of the overall firm rather than having this onus on loyalty to the advisor. I think the ties that bind have been loosened over the years, and anything that firms can do to increase the loyalty to the institution as a whole has got to be a good thing. I think another thing that needs to be evidenced is that often the work of managing portfolios and managing wealth really effectively is about what you don't do. And so being able to show the client that you spoke about a potential investment to an investment specialist and went through a thought process and decided that actually it wasn't for your client base or not at this particular time is a real show of value that maybe you don't necessarily get if it's just the bald buy and sell decisions that you're making.
Martin.
I think it's highly important that you're able to collaborate. And I think for many firms today it's difficult. It often happens still the old-fashioned way. You might bring an investment expert into a meeting, but that's not a very scalable model. So if we were to kind of envision how would this ideally look like? I spoke to one of the heads of one of our private banking clients, and his quote was that actually today many of their clients, high-net-worth clients, they're actually more educated and they're more knowledgeable about the financial markets than their advisors. So this actually puts into perspective that why wouldn't you actually imagine a situation where clients can speak directly to investment experts? So thinking about a digital experience, a client experience, by which the client not only can view their holding, investment performance, etc., but you can actually communicate directly with the investment experts and the advisors. This makes it much more efficient for all parties, and it just gives comfort for the end client that I can basically just chat with the investment expert or arrange a call or a meeting. I think that is going to be where there will be a lot of money spent, and I know from a lot of the tier 1 players, they are looking into these things, and this is also what we are working with clients about, integrating kind of social capabilities throughout the technology. It's going to be really powerful, I think.
Well, thank you very much indeed, team. We have some questions from the audience coming in. Thank you very much, audience, for sending in some great questions. The first one I'd like to address is this: how should wealth managers approach social media, and for what purpose? A great question that comes up around the world when we do seminars on this kind of topic. Wendy, I think you might like to lead off on that. Wendy Spires.
Yeah, I think the first thing to note on the social media front is you have to be fairly careful. I don't think anyone wants their wealth manager necessarily popping up on their Facebook feed. Certain spheres should be separate to my mind at least. But there are various uses of social media that can be really useful for clients and also for institutions. Something that I think might be a future development that we could see before too long is the use of mezzanine social media platforms which allow groups of clients to talk to their advisor or a group of advisors within the firm. What that means is that the conversations that people are having with their advisors after that initial kind of information bombing, it just means that they are more valuable and advisors aren't having to have the same conversations with clients over and over again if, for example, something happens such as the potential for a Brexit. So they don't have to keep having this conversation again and again. They can come to it with a client base that's a lot more informed. They can maybe bring in a colleague from elsewhere in the bank. So that's a very cost-effective way, I think, to allow for the more efficient servicing of clients. That's one use of social media. And also it's, again, a hygiene factor really today to have some kind of shop window in all of these spaces. Whether firms go into that completely and allow their advisors to tweet, for example, is something they have to make as depends their culture, really, I think.
Martin, have you got a response to that question on social media?
No, not really, but I just know that this is high on people's agenda.
Yeah.
Because it's a little bit the same as with digital experience. We all know that we need to do something, but it's just how do we actually do this properly and in the right professional way. So I don't think there's like one solution, but it's definitely something that is heard and being discussed out there.
So should social media be used for KYC purposes, do you think, in terms of onboarding clients and using as much information as possible to see whether a client is suitable, whether they've engaged in nefarious activities? Is social media a relevant place to look for clues on that, do you think, Wendy?
I think it's definitely an important piece of the armoury on the KYC front broadly, because you can be so effective with social media. It allows you to see what people's interests are, who their associates are. It allows you to maybe differentiate between two people who may seem to be similar but are revealed to be completely different people. So as part of the mix, it can be very, very, very useful indeed, particularly if you can somehow manage to automate those kinds of searches, because as I understand it, at the moment there's some very expensive compliance people spending a lot of time Googling. So anything that we can do to shave some hours off that has got to be good for cost control.
Thank you very much. We have another question that's looking more at the technical aspects of the research report, Wendy. Were we able to differentiate between assistants and relationship managers in the research, or have we aggregated RMs and their assistants' time?
Yeah, we've aggregated that. If we had the requisite time and space, we'd have liked to have drilled into these issues in a lot more depth, but I think it needs to be remembered that not everyone does have that level of support nowadays, and people are being asked to run very, very big client books. There's actually a table of average client rating figures in the report that you can have a look at. But yeah, while some people do have a lot of assistance, other people really don't, and they're pushed for time.
Okay, thank you very much, Wendy. Another question from the audience. Which technologies are highest on advisors' wish lists today? And I'm going to direct that first to Ian, please.
Oh, that's a challenging one to answer. So maybe the best way to sort of look at that is to say it depends on what the legacy models look like. So let me paint you a picture. I mean, Wendy mentioned laggards and leaders. So if I paint you a picture of a laggard, and then I give you a quick picture of the leader, and then you'll see which technology systems come into play. So from a business point of view, I think we think in the UK as many as 2/3 of firms haven't really prioritised any investments or significant investments in client-facing systems. And in conjunction, they also have legacy back office systems where the majority of the investment is directed. So what that means is advisors get unfriendly screens. They need to work with multiple systems, as we've mentioned, and also data. And there's a lot of rekeying of information and manual interventions with multiple passwords, which all takes advisor times. Now, this is in stark contrast to the leaders who have made investments in good client-facing systems. These tend to be around the CRM area, they tend to be around the investment management area, they tend to be around sales intelligence, customer intelligence, and user-friendly dashboards with client prompts and collaboration tools, so that you get the full advantage of the technology in being able to collaborate with wider teams in the bank, and also for the advisor to collaborate with clients. Additionally, a further benefit is compliance can be built into some of these workflows, which means you automatically get evidencing, and you can also stop people doing the wrong kind of things, which in today's environment is very, very important. Now, if you take the comparison between the legacy, the laggards, and the leaders, the commercial and compliance case now becomes extremely compelling. The difference in performance and client experience that we've seen can be very, very significant between the laggards and the leaders. So, for example, just to give you something on revenue generation, 20% increase in new business generation. You can get higher advisor time focused on clients. You can also find that activities which previously took about 9 or 10 days can be collapsed into a few minutes. So I think the potential to envision and enable new ways of working and to generate superior client and advisor interactions through technology can be very, very significant. And I think more advisors are realizing the difference that they will have by moving or with different private banking and wealth management firms. So I think we're going to see big changes in the next 2-3 years.
Well, another question that's just come in, very important one. What is most needed by wealth managers? Is it, number one, more time with clients, or number two, enhanced professionalism? Who would like to lead off on that? Ian first, and then Martin.
Well, I think my view is that it's the enhanced professionalism. I think what you're seeing is a change in advisor skills. I think we've mentioned this significantly. The clients are changing, the regulations changing, the product innovation is there. So it's much more now about advisor knowledge management, getting the ideas and the advice into the hands of the clients much more professionally in the past. And I think also you're seeing regulators driving enhanced professionalism in the industry with things like RDR and MiFID II. So my vote would be for enhanced professionalism. I think also as secondary, of course, we want more time with clients to get that knowledge and advice across.
Awesome.
Yeah, no, I'd say I'd place my bet both on professionalism and time, but I fully agree with what you're saying, Ian. But I do believe that it is a huge challenge in the industry that advisors have so little of their overall time to spend on clients. So if you get freed up of some of these more administrative tasks, you will eventually have more client-facing time. And all surveys show that in general, even though clients want a digital experience, they still want to have those ongoing dialogues with your advisor. But I do agree professionalism is definitely important. So I'm going to go in both camps actually.
Very helpful. Thank you very much. Next question. How can relationship managers and others make a good business case for improved technology? So business case for improved systems. Martin, would you like to have a go at that one, please?
Yeah, I think this is the number one question actually, and I think many firms out there, they ask themselves those questions. And the tricky thing is that it is very difficult up front to make a detailed business case. However, I think people, they are more and more realizing that it's not a question about building a business case before you actually make the investment. You need to ask yourself, in 2015, am I able to actually fulfill my business strategy and my business plan over the next 3 to 5 years without any investment in, for instance, digital client experience? And I think most firms will answer no to that. So this is not about cost only. This is actually about, do or die. And I think that when we speak to clients, we don't have like a long statistic on this, but when we speak to clients and we talk about what is the ROI and what's the impact on business that they have realized, it is really significant numbers that they are actually saving, and it's significant business growth that they are able to bring in on this. So anecdotally, I'll say that when we had our large client conference, we had worked with some clients, and we were allowed to kind of share their stories and the business case they put together. And they were some really top-notch stories about savings and how they have fulfilled business plans, way ahead of schedule, partly due to their technology investments. And after we had that presentation, actually several other clients came up and said, why didn't you include me? Because we actually had an even higher ROI. So it almost became a competition. So I think that this is the case is that it's not about building the business case up front, because the business case, the challenge with that is it takes several years in order before they actually realize, have I actually fulfilled, that has it been a great return on investment. So, but I'd just say people, they just need to do it, no matter what. But obviously you need to spend your money intelligently.
I think one thing we're seeing is that you can get early payback in a very short space of time. So what do I mean by that? Well, some of the winners or the leaders are adopting a more quick-to-market approach. So what they do is they go and talk to the clients around what kind of areas that they could benefit from in terms of improvement. They talk to the advisors. They then develop new concepts very rapidly and test them again. And so they iteratively develop stuff that they can test in a very short space of time. And then if it looks like a fly, you're talking here about 12 weeks. If it looks like it will fly, then your business case is there, and then what's the question of is scaling it up and rolling it out. Martin, what do you think on that?
Yes, absolutely. Yeah. Because what we actually found is that it's actually more challenging to build a digital experience than what originally expected. So we have an iterative process going on with wealth managers and their clients to get feedback in developing that. And that actually helps to speed up kind of the return on investment and makes the business case more apparent, because you're actually involving all parties in that process, which makes it much more easy to get a sound business case very, very soon.
Well, we're heading towards the end now, so I'd just like to ask each of the panelists to sum up with a few key words. So I'd like to start, please, with Wendy.
I just think that as I say, the main takeaway from this report is, as predicted, that technology is becoming a real retention and recruitment issue, and that is part of the return on investment that we're talking about here. That recruiting the very brightest and best advisors and keeping them happy so that they want to stay, and therefore keep their clients with the firm as well, has to be the name of the game. And if you're being held back as a business by poor technology, then that's surely going to be reflected on the bottom line before too long.
Ian Woodhouse.
Well, I think sort of three brief points. I think in the new world, advisors need much sharper ways to engage clients, leverage information advantage, and to help them professionalize, as one of our participants has rightly pointed out, in order to provide more personalized solutions and advice, and to make sure the execution is flawless. I think that's the first point. I think the second point is the competitive environment's changing. Brand and size of traditional wealth managers, no longer confers perhaps the advantage it used to, and what we're seeing is advisors need more digital platforms, and some of the newer entrants and some of the leading incumbents who have adopted more client-centric advisor models are pulling ahead. We're early stages, but it's certainly something that can't be ignored, particularly with the threat at the low end from robo-advisors using technology. I think the third and last point really is the early winners, I think, have been very quick to market in understanding the changing client needs. I think they have adopted an iterative, short approach to developing concepts, testing the concepts, because all these front office advisor models are relatively new. So testing and refining in a short space of time, and then testing and making sure they work and then scaling those up. And I think we can do that in a much shorter time frame than we used to. So I think these three things combined together mean that I think we're going to get much more benefit from our investments in technology around the whole area of advisor productivity and being more client-centric.
Martin Engel.
I will do it very brief. I think that this is proving that success within wealth management goes hand in hand with smart technology investments. And that's kind of my key takeaway.
Excellent. Well, thank you very much indeed, Wendy, Ian and Martin. Thank you very much also for participating in this webinar and listening in and asking such great questions. I'd just like to draw your attention to our next study, again with Advent, which is looking at technology and operational trends in wealth management. That will be the subject of another big and successful research report. So please look out for the questionnaire on that and fill that in too, please. So thank you very much and see you again.